Welcome to the Radio Revenue Podcast. When you think about high fashion, you might picture runways, maybe glossy magazines. But have you ever stopped to consider that behind all that glamour, these luxury brands operate under, well, really intense financial scrutiny, just like any other big corporation?
Absolutely. It's not just about artistry. There's a huge business engine humming underneath.
Exactly. And today we're actually going to take a deep dive into that very engine. We've got the recent 10K filing from Tapestry Inc. They're the parent company of Coach, Kate Spade, and, until recently, Stuart Weitzman.
Right. Some pretty iconic names there.
For sure. So our mission today is really to cut through all the dense corporate language in this report. We want to pull out the critical insights, those aha moments, maybe some surprising facts, just to give you a clearer picture of how a major player in the luxury market actually works.
And these 10K filings, for anyone maybe not familiar, they're annual reports filed at the SEC. Public companies have to do them. They're incredibly detailed.
Dense is probably an understatement sometimes.
Oh, definitely. But they offer this comprehensive, almost forensic look at a company's finances, its strategies, the risks it's facing. You really get the full picture.
But it's like the company's annual health check, basically.
That's a great way to put it. It shows not just with the financial results, but the how. How are they managing global operations? How are they adapting to market shifts? Navigating geopolitics. It's all in there, showing their strategy for growth.
Okay, let's get into Tapestry itself then. They call themselves a house of iconic accessories and lifestyle brands. You mentioned Coach, Kate Spade. Stuart Weitzman was part of that picture too until August 25. Their big focus, they say, is on innovation and authenticity. So looking at the headline numbers for fiscal year 2025 that ended June 28th, 2025, the overall picture seems, well, pretty decent. The total net sales were up 5.1% to just over $7 billion.
Right, $7.01 billion.
Yeah.
And slightly higher, 5.3% if you adjust for currency fluctuations. So, yeah, positive growth overall.
But like you often see with these big holding companies, the story gets more interesting when you break it down by brand, right? What did you see there?
That's exactly where it gets fascinating. It's really a tale of, well, quite different paths. Coach, their biggest brand by far, had a really strong year. Net sales up almost 10%, 9.9% to be exact, reaching $5.6 billion.
Wow, nearly 10% for a brand that size is impressive. What drove that?
It was heavily driven by their direct-to-consumer, or DTC, sales. So selling directly through their own stores and website rather than wholesale. And that strength was seen particularly in North America, Europe, and Greater China.
Yeah.
It shows they're really connecting directly with customers, especially online.
Okay, so Coach is the powerhouse. What about the other?
Well, that's where the contrast comes in. Kate Spade saw a pretty significant drop. Net sales were down 10.3% to $1.2 billion.
Ouch. Okay, that's quite a swing compared to Coach.
It really is. And then Stuart Weitzman, the smallest of the three, also saw a decline, down 10.9% to about $215 million. That's only about 3% of Tapestry's total sales.
And you mentioned they actually sold Stuart Weitzman just after this fiscal year ended.
That's right, August 4th, 2025. So
Yeah.
that sale really reflects Tapestry making a strategic decision, likely looking at those numbers and deciding to, adjust their portfolio, focus their resources probably more on Coach, and turning Kate Spade around.
Makes sense. Okay, let's unpack this a bit.
Well.
You've got Coach roaring ahead, Kate Spade facing headwinds. What does the 10K tell us about the big strategic moves, maybe the high-stakes decisions Tapestry made during the year that shaped these financials, beyond just regular sales operations?
Oh, there was a major event highlighted in the 10K that had huge financial ripples. And it's actually something that didn't happen.
Oh, intriguing. What was that?
The terminated acquisition of Capri Holdings Limited. Remember that potential mega merger in the luxury space?
Right, that would have brought Michael Kors, Versace, Jimmy Choo under the same roof as Coach and Kate Spade. Huge deal.
Exactly. And Tapestry had already done the groundwork to finance it. Back in November 2023, they issued a massive amount of debt, $4.5 billion in US dollar notes and another $1.5 billion in euro notes.
Okay, so they raised about, roughly $6 billion for a deal that then got called off?
Precisely. The U.S. Federal Trade Commission, the FTC, filed a complaint to block the merger. That led to a court issuing a preliminary injunction in October 2024, basically putting the brakes on the deal.
And Tapestry just walked away then?
They terminated the agreement shortly after, on November 13th, 2024. But walking away wasn't free, not by a long shot.
Ah, okay, so what was the financial fallout?
It hit them pretty hard. They recorded a $120.1 million loss on extinguishment of debt.
Loss on extinguishment. Okay, can you break that down?
Yeah, think of it like this. They borrowed billions for the deal. When the deal died, they paid back that debt early. But there are often costs associated with doing that, like redemption premiums, basically penalties for early repayment, and fees or setup costs they couldn't recover. So that $120 million is essentially the cost of arranging financing for a deal that never materialized.
Got it. Just evaporated value, essentially.
Pretty much. And on top of that, they had another $88.8 million in SG&A expenses, that's selling, general, and administrative costs. This included having to reimburse Capri for some of their deal-related expenses, plus all the fees for lawyers, bankers, consultants involved in the failed merger attempt.
Wow. So over $200 million in costs for a deal that didn't even happen. That must have really impacted their net income for the year.
Hugely. Their reported net income for FY25 came in at $183.2 million, which sounds okay until you realize it was down a massive 77.6% from the previous year, FY24.
77%. That's a staggering drop.
It is. But here's the crucial context, and this is why digging into the details matters. If you exclude those non-recurring charges, the $120 million debt loss and the $89 million in deal expenses, their underlying net income, sort of their operational profit, actually increased by 13.4% to $1.13 billion.
Ah, okay. So the core business, ex-Capri fallout, was actually performing better year over year.
Exactly. It's a really stark example of how a major strategic move, even a failed one, can dramatically distort the headline numbers. It underscores why you have to look past those one-off events to see the true health of the ongoing operations. The cost of failure in M&A can be incredibly significant.
That really puts things into perspective. Okay, so the failed deal explains the big profit swing. Let's circle back to Kate Spade, though. You mentioned the sales decline. Did the 10K give any more clues about what's driving the challenges for that specific brand?
It did, and it points to some fundamental issues. In the fourth quarter of FY25, Tapestry recorded massive impairment charges related to Kate Spade.
Impairment charges, like writing down the value.
Precisely. They took a $244.1 million hit on goodwill impairment and an even bigger $600.7 million hit on the brand's indefinite-lived intangible asset value. That totals over $850 million.
$850 million just for Kate Spade.
Just for Kate Spade. Basically, the company had to formally acknowledge that the Kate Spade brand and the associated goodwill on their balance sheet from when they acquired it wasn't worth what they previously thought it was.
Why such a huge write-down? What triggered that?
The report cites a reduction in both current and future expected cash flows. Essentially, they don't expect Kate Spade to generate as much profit going forward as they had projected. Part of this, the report notes, was due to cost increases due to changes in tariff and trade policies.
Oh, tariffs again. We keep hearing about those.
Yep. But it also mentions broader factors like changing customer tastes, the impact of promotional activity, maybe having to discount more heavily, and general economic volatility. It paints a picture of a brand struggling to maintain its perceived value and pricing power in a tough market.
So it's a mix of external pressures like trade policy and internal challenges like perhaps resonating with current customer trends.
That seems to be the implication. It raises that big question for any fashion brand. How do you stay relevant? How do you maintain that cachet when tastes shift so quickly and the economy is uncertain? This impairment is a financial reflection of those struggles for Kate Spade.
It really shows how those abstract concepts, brand value, customer taste, translate into hard dollars on a financial statement. Okay, so building on that mention of tariffs and economic volatility, how does Tapestry talk about managing these wider external risks, things beyond their direct control?
They definitely acknowledge them as significant factors. The 10K is clear that their products are discretionary items, meaning people buy them when they feel confident and have extra money, but they cut back when times are tough.
So they're sensitive to things like consumer confidence, unemployment, inflation.
Exactly. All those macroeconomic indicators matter. They also specifically mention changes in tourist shopping patterns, which is a big deal for luxury, especially historically, spending by Chinese tourists traveling abroad. That's a dynamic that's been shifting.
And the trade policy piece, you mentioned tariffs impacting Kate Spade. Is that a broader concern?
Yes, very much so. They noted the U.S. government announced new tariffs in the second half of FY25. Tapestry actually put a number on the expected hit. They project these tariff and trade policies will negatively impact their operating margin by about 230 basis points in fiscal 2026.
230 basis points, so 2.3 percentage points shaved off their operating profit margin. That's significant.
It's a substantial headwind, and it makes sense when you look at where they manufacture. For Coach, key locations are Vietnam, Cambodia, Philippines, India. For Kate Spade, it's Vietnam, Cambodia, mainland China, Philippines. Changes in trade rules with any of those countries can directly impact their costs.
So you really see how global politics and economics flow right down to the price of a handbag or the profitability of a brand.
Absolutely. It's not just design and marketing. It's managing a complex global supply chain and anticipating these huge external forces. Tariffs can squeeze margins if they absorb the cost or hurt demand if they pass it on to consumers. It's a constant tightrope walk.
So faced with these headwinds, economic uncertainty, trade issues, shifting tastes, how is Tapestry fighting back? What investments are they making to navigate this?
Well, they're definitely spending on marketing. Total marketing activities in FY25 hit $744.5 million. That's almost 11% of their net sales, and it's up quite a bit from the previous year, which was just over 9%. So they're clearly investing to keep their brands visible and desirable.
Pushing the message out. Makes sense. What about technology?
That's the other big area. The 10K talks about continually enhancing digital technology platforms. This is all about boosting e-commerce and their direct-to-consumer capabilities, which, as we saw with Coach, is a key growth driver.
So improving the online shopping experience, logistics, that kind of thing.
Yes, but it goes deeper. They explicitly mention leveraging artificial intelligence, both predictive and generative, and machine learning models.
AI in fashion. How are they using it?
For a whole range of things, it seems. Data analytics, demand planning, tailoring marketing messages, personalizing the customer journey online, optimizing pricing, and even informing product creation itself.
Wow, so AI isn't just a buzzword for them, it's being integrated across the business.
It appears so. The increasing importance of digital engagement, social media, understanding consumer behavior in real time. It means companies like Tapestry have to invest heavily in AI and machine learning. It's not just for efficiency anymore. It's about staying competitive and relevant.
It's really striking how tech-driven even a traditional industry like fashion accessories has become. Okay, let's shift focus slightly. Tapestry talks about its corporate responsibility strategy called Fabric of Change. It covers things like people and sustainability. What stood out to you there?
This is definitely an area getting more attention from investors and consumers alike. Under their Power of Our People pillar, they highlight having around 19,000 employees globally in FY25, mostly in retail.
That's a big workforce.
It is. And they make a point of mentioning good employee relations and having no history of strikes, which is notable for a large retail employer. They talk about core values like embracing difference by design and backing that up with competitive pay based on performance, plus benefits like parental leave and wellness days.
So focusing on the employee experience.
Seems like it. They also mention moving to quarterly performance reviews, which suggests a more dynamic approach to feedback and development, and things like an associate relief fund and matching employee donations show a community focus too.
How does this fit into the bigger picture of corporate governance?
Well, companies today are under a microscope, right? It's not just about profit anymore. Stakeholders, customers, employees, investors increasingly care about social and environmental impact, the whole ESG picture. So Tapestry detailing their human capital practices, their diversity efforts, their community involvement. It's a response to those evolving expectations. It's about building reputation, attracting talent, and potentially mitigating risks. They mention receiving awards like Great Place to Work, which they clearly see as valuable validation.
Right, it's part of being a responsible modern corporation. And speaking of risks in the modern world, cybersecurity must be high on their list, especially with all that tech investment.
Absolutely critical. The 10K calls cybersecurity a risk management priority and notes it has board-level oversight with the Chief Information Security Officer, the CISO, and the CIO giving quarterly updates to the audit committee.
So top-level attention, what are they actually doing?
They list a whole suite of tools and practices. Vulnerability management, scanning their systems for weaknesses, security monitoring, having incident response plans ready, and importantly, ongoing employee awareness training. Because often, the human element is the weakest link.
True. Phishing emails and things like that?
Exactly. And interestingly, they specifically call out the increasing concern around AI being used by attackers for more sophisticated social engineering. So even as they adopt AI for business benefits, they're also aware of how it's changing the threat landscape they need to defend against. It shows how interconnected these tech trends are.
It really does. Okay, we've covered brands, strategy, risks, people, tech. Let's bring it back to the investors. How does Tapestry show it's delivering value back to its shareholders based on this report?
There are two main ways highlighted. First, they pay a quarterly cash dividend. In FY25, it was $0.35 per share each quarter, adding up to $1.40 annually. That cost them about $299 million for the year.
Okay, direct cash returns. What's the second way?
Share repurchases or buybacks. They initiated a big $2 billion accelerated share repurchase program, an ASR, in November 2024. Plus, they still had $800 million authorized under a previous buyback program.
So, spending significant money buying back their own stock, how did that help shareholders?
Well, the idea is that by reducing the number of shares outstanding, each remaining share represents a slightly larger piece of the company. This can boost earnings per share and theoretically support the stock price. Both dividends and buybacks are ways to return capital, signaling confidence in the company's cash flow and future prospects. But of course, they depend on the company actually generating that strong cash flow consistently.
Right, you need the profits to fund the returns. And speaking of finances, what's their overall debt situation look like after all this?
As of the end of the fiscal year, June 28, 2025, their total debt stood at $2.39 billion. Not insignificant, especially after issuing and then partly redeeming that debt for the failed Capri deal. And of course, the 10K lists other ongoing risks protecting their intellectual property, which is crucial in fashion.
Huge. Managing all their retail store leases and just the general market volatility we've been discussing.
It really paints a picture, doesn't it? Running a global house of luxury brands like Tapestry is incredibly complex. It's this constant juggling act, balancing creative design with efficient operations, managing finances prudently, navigating global trade, adopting new tech, keeping employees happy, and responding to constantly shifting consumer desires. It's far more than just selling nice bags.
Absolutely. So thinking about all this, what does it mean for you, listening in, for anyone trying to understand this fast-paced business world? I think it's about appreciating the layers, seeing beyond just the brand name you might recognize on a storefront.
Yeah, understanding the intricate web of business decisions, global forces, financial maneuvering, and even human capital strategies that shape these iconic companies.
And maybe here's a final thought to consider. Think about how one single event, like that terminated Capri acquisition, could send such massive financial ripples through Tapestry's entire annual report, dramatically changing their reported profit.
Or how something seemingly remote, like a change in U.S. tariff policy, can directly lead to a major brand like Kate Spade having to write down its value by hundreds of millions of dollars.
It really hammers home just how interconnected everything is: global markets, policy, consumer behavior, and corporate finance. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.